Thank you for joining us. It's a pleasure to have with us today Jonathan Brolin, the founder and managing partner of Edenbrook Capital.
Yes.
Welcome. It's a pleasure to have you on the program.
Thank you, Oliver. Nice to be here.
Well, look forward to learning from you. The topic for today is private equity approach to investing in public markets, and you have a focus on smaller companies.
Correct.
So look forward to learning about that.
Right.
And where are you finding opportunities in today's market? So before we do that, tell us a bit about yourself and how you got interested in investing.
Sure. Well, investing is something I've been following since I was a kid, through other family members who were involved, etc. Professionally, I started out in investment banking. Moved from there. I worked at Oppenheimer in the old days, when Oppenheimer was still a partnership. Moved up to Boston after that to work in a private equity firm. Spent a few years doing that before going back to business school. When I was in business school, switched over to the public buy side, studied value investing up at Columbia, and worked in a very traditional long-only asset management firm in the city for a few years called Steinberg Asset Management, and then helped start and ran a business called RLR Capital in 2005. Managing partner, a guy named Rob Rosen, who had excellent investing, operating, financial background on Wall Street, was our managing partner. And our strategy was very similar to what I'm doing now, which is a private equity approach to public investing, finding undervalued, small, sometimes mid-cap companies, laying out a roadmap for management teams and boards to follow to unlock value. What are things they could be doing today to really increase value 2 to 3 years from now? And the distinction between that and a lot of activist investors, if you will, is it tended to be more of a collaborative approach, less confrontational, not running directors or trying to change a business coercively. And that is a business model that has worked very well for others, and this is just a different approach to it. It's more of drawing on that private equity type of background and trying to work with management teams towards value creation.
Well, I look forward to learning about some of the finer nuances in that approach, and also talking about some examples there. Yeah, look forward to it.
Great. Likewise.
Well, Jonathan, a lot of people have perhaps some misconceptions about that private equity approach in public markets, and as you
Sure.
said, there are some approaches that are labeled activist, and it would be really helpful to understand from you where do you think really the value of such an approach lies, and what the approach really is.
Sure. So the market, it's funny, if you go back 100-something years, you'll read market commentary where everyone's complaining about how everyone's so short-term oriented. So for me to say people are short-term oriented today, it's been a theme for many years, but it feels like it's increasingly so. Even in the nearly 20 years that I've been working on Wall Street, it feels like the time horizon that people have for investments has gotten much shorter. There are lots of different reasons for that. Certainly the ease of accessibility of information is a big part of that. People get information much more quickly, they make decisions much more quickly, and because there's more data, I think people feel compelled to make decisions more often, as opposed to 20 years ago. Information came out less frequently. You had to go, if you wanted an SEC report, you couldn't just go online and get it in 5 seconds. It was, I remember when I worked in investment banking, we had to go down to the library and being in the library at 3 in the morning, pulling disclosure documents off of CD-ROMs, and that will still seem like a walk in the park compared to what people had to do 20 years before that. But anyway, the time horizon has become so compressed that time alone, if you have the investment thesis right, and you've found an opportunity with the right risk-reward characteristics, time itself can be an arbitrage factor and can mean the difference between your success and failure in a given investment. And so what we do is we tend to focus on opportunities that we think have a high likelihood of playing out according to the risk-reward framework we've developed over a 2 to 3 year time horizon. Now, comparing that to a more traditional private equity firm that might have anywhere from 5, 7, 10 year type of time horizon, it's certainly more compressed than that. but compared to the average holding period on Wall Street these days, it's more like centuries. So we will own these things, and because some of the businesses tend to be less liquid, not illiquid, but less liquid small cap companies, it really helps to think of them as private investments. Use market opportunities. If it's a risk-off day and everything's selling off and small caps are off 1% and some particularly liquid ones are down 6%, and you have the opportunity to add to something at a favorable price, fine, take advantage of it. But otherwise, the idea is not to focus so much on the day-to-day idiosyncratic movements of prices, but to take a longer-term view. And it's very different from the we rent these things, we don't own them mentality that is very prevalent amongst a lot of mutual funds. And that's worked very well for a lot of people. This is just a different way of looking at it, which is to say we're going to be owners of these businesses. We own a portion of them by being public shareholders, and there are things we can do to help them along the way, much like we would do if they were private companies. And the fact that other people could come in and be owners along with us, alongside us, and maybe be very passive, maybe have no idea what the business is really doing and not participate in the process and potentially still benefit from it, well, those are the dynamics of the public market. So to that extent, it is different from private equity, whereas if you're raising private capital, you're going in and investing maybe by yourself, maybe with one or two other firms, they're generally all working cohesively towards that value creation. Here, it's a little bit of a different framework. But the idea from our perspective is we do just as much work if we own 0.5% of a company as we would if we owned 40% of it. We want to know the business as well, if not better than anybody else, and be able to provide real value to management teams and boards by making suggestions, things they can be doing today to increase value 2 to 3 years from now. And so one of the reasons why I think that can work in this kind of an environment is A, the time horizon, but also a lot of these smaller companies often don't have the managerial bandwidth, simply not enough people on the management sides, often at the board level, to think through what are those things they should be doing today to create that value several years from now. It's often all about getting through the quarter. Some of these companies are small. They may be dominant players in their industry, in their niche. They may have 40, 50, 60% market share in some niche that's growing nicely, has good secular drivers behind it, but it's underfollowed, if at all followed by Wall Street, and management's constantly just trying to get through the quarter. So if you can come in and sit down and take a different approach and say, I own your stock, here are things I think you can do to increase value, and here are things that we can do to try to help you get there, between introducing them to customers, potentially new shareholders, maybe we'll help find them sell-side coverage, we might introduce them to bankers or private equity firms down the road if that's an appropriate thing to do, or they may find them on their own. But whatever we can do from a strategic standpoint, how to communicate what they're doing. And again, we don't want to know anything nobody else knows, but if a company is saying, well, we're going to do X, Y, and Z, and here's how it might create value, and that might be the right program, then we may simply say, well, why don't you communicate that? That message doesn't come across in your earnings calls. Nobody has any idea that's what you're doing. Nobody's following you. So here's how you can do that. Maybe you have a classic example of something we'll get involved in is a multi-division business where you have a smaller, higher margin, faster growing business that's being dwarfed by a larger, lower growing or possibly shrinking, lower margin business. And they may report as one segment and it just looks like one big glob of junk. And if you screen for it, it might look expensive because, again, you're not getting a full picture of what the future earnings profile might look like. But if you're willing to have a little imagination and figure out what this could look like 2 to 3 years from now, you can see how the lower margin business is going to become less important relative to the smaller one, and you're going to have all this margin pull through over the next several years and what that might do in terms of free cash flow generation, etc. So if you can help a management team communicate that to Wall Street, maybe by encouraging them to segment report, which is something we've done before, instead of having just reporting as one revenue, let's show both of these businesses, because that also helps a knowledgeable buyer think through what they might want to pay for the business. Then they can see that other business and say, there's something here. And maybe the way to unlock that value is for somebody to take the business private, sell those two businesses off to somebody else, maybe they have nothing to do with each other, or maybe they do, and there's some way that a larger company could take advantage of the two different divisions. But our goal is to try to help companies unlock that value over a multi-year period, sometimes by being more patient, sometimes by coming with some ideas that people haven't approached them with.
And it's interesting. I want to pick up on something you said. So sometimes these types of opportunities don't screen very well.
Correct.
Appear expensive, let's say, and one might omit the opportunity as a result.
Right.
So help us understand with that mindset how you go about
Finding ideas. It's a
ideas.
very organic process. There are a handful of industries that I've invested in with particular levels of concentration over the years. Business services being one of them. It's very broadly defined. It could be tech services, medical healthcare services, etc. But I tend to stay within a handful of industries that I know pretty well. And by following certain companies in there, you follow trends. You see other companies in the space, and you can identify opportunities. I read a lot of different trade publications for the handful of industries that I follow, and so you can start to pick up things by being in an industry more often. Who might be taking share? And you say, oh, those people are taking share. If I look up their profile on Bloomberg or Yahoo Finance, it doesn't even say they're in that business. And then you go and you look in the 10K, and they don't necessarily list that as a separate segment, but you can tell that that's a business unit, or it's a way they operate it as a business unit, even if they don't report it that way. And so maybe that's an opportunity for them to grow that business down the road. You start doing more research, you go visit the company. So it's all sort of an organic process. The only type of real screen I like to do is a very, very sophisticated one called looking at the 52-week low list, because I like, so sometimes we'll find something because people just overreact to something. Something you followed for a long time, it's on your watch list, you like everything about it except the price, and you have it there waiting for something to happen, and then there's an earnings surprise, or people overreact to something short term, and that ends up, at any given point, that can be a third or half of our portfolio might come from just taking advantage of people's overreaction to a short-term thing. Sometimes it happens with something we already own, in which case we have a little short-term pain, but it's a great opportunity to buy more of it. But a lot of the other things just come across from just continuing to do research. I don't spend every day in the office. I like to go out and meet with companies, certainly all of our companies, as well as other companies, going to conferences, talking to companies, but also talking to industry participants that are not public companies, private companies, experts in the industry, consultants, research firms, etc., just to try to create a mosaic of what's going on within a certain area and see where value might be shifting over the next couple of years. And that goes back to the private equity side of it as well, which is, when I worked in private equity, we would try to get to know everything, not just about the company, but what's going on with the competition, what's going on upstream, what's going on downstream, and how is that value likely to shift over the next couple of years. Because if you're making a longer-term investment like you would with a private company, you really want to have a point of view on what's going to happen 3, 5, 7 years from now. If you're investing because you think a company's going to beat the quarter, that's a little bit less important. So to take that type of mindset and figure out where value might shift, or how something that looks like an acorn now could be a tree 10 years from now, that tends to be more of an organic process, but it just comes from following a handful of industries and trying to figure out where the changes are in value creation in that space, and trying to find players who might be well positioned to take advantage of that.
And I think it's hard to argue with what you're saying. It makes sense to me. It's very plausible to do an approach like that to be successful in investing. Perhaps you could use an example to help us appreciate more of the challenges, really, of what are some of the stumbling blocks, and how you have learned over the years and with your experience to really avoid some of the difficulties of applying that approach.
Sure.
Just to help us appreciate really what it takes to employ it successfully.
Sure. Well, first off, I should also mention that there are plenty of examples of companies we have invested in and are invested in now where we don't have to do that. There are management teams and boards that are already doing all the right things. It's just that the market isn't appreciating it. And so when you go and meet with them and you see that all the things that they're doing are the right things to create value, those are actually the easiest ones because you can certainly monitor it and make sure that your risk reward is well protected and constantly retest your investment thesis. But to have a well-aligned management team and board that are doing the right things already is a great opportunity. And because the active ones take so much time, we can't actually have a portfolio of 15 to 20 names where every single one of them we have to do the same high involvement work with. It's inefficient and almost impossible. So we tend to do it with about a third of the names in the portfolio where we're really actively involved, and those tend to be, for the most part, the smaller market cap ones. So most of the stuff we'll do is in the $200 million to $2 billion range. We'll go a little under 200 if it's a very unique situation and there's some liquidity, but it tends to be those, generally the sub $500 million ones where we really get more active with because they tend to have less managerial bandwidth or board bandwidth, or they're less well followed, and so the opportunity tends to be greater there.
So is it right then that basically the approach is really all about value, and it's not in a way rigid, it's just another tool in your arsenal
Absolutely.
to employ to
Correct.
create that value.
And if we don't have to get involved, that's fine. I'm absolutely not looking for situations where we have to get involved. But sometimes you see ways that you can help a company because companies that have very little sell-side coverage, even if they're doing reasonably well, if there isn't a lot of float, maybe it's a company that has, we have a couple of examples of companies with 12 million shares outstanding. I don't know why it's that magic number, but we have 3 companies with 12 million shares outstanding, give or take 500,000 shares. Founders or owners own a decent chunk, so there's simply not that much float in the names. So they're not that easy to buy. It's hard to get a big institutional investor to necessarily want to buy them because they're too small, they have to own too much of it, they're not that easy to buy, etc. But if you can help raise the awareness of those companies, that can create value in and of itself, presuming that the company is already in the process of creating the business value. Anyway, we do tend to focus on those smaller ones as the ones we get more involved in. But the active part of it is, as you've said, it's really just another tool. Everything is rooted in value and is really rooted in a very particular risk-reward framework. So maybe I'll take a second on that. The way we'll evaluate an opportunity is, from a financial standpoint, we will do 3 different cases: a base case, an upside case, a downside case. That's not that unusual. We'll probability weight those based on what we think the outcomes are likely to be over the next, again, 2 to 3 years. And we'll only invest in a company if the upside is, and a reasonable case upside, is at least 4 times what a reasonable downside is. So if something can go down, again, what the value of the whole business is. It's, intrinsic value is thrown around all the time, and I'm not sure people necessarily have a great handle on what that really means, but we're trying to understand what the value of the whole business is. So in our estimate, what is likely to happen to the value of the business over the next 2 to 3 years? If the value of the business can go down 20% over that time frame, then it has to be able to go up at least 80% in a reasonable case over that same time frame. So that's your 4 to 1, 80 to 20. Sometimes it's 15 to 75, whatever it might be, which is 5 to 1. That can change. But if it's lower than that, then I don't think you're getting enough reward to warrant compensate you for the risk that you're taking. So that's a rule of thumb that we use on everything. And sometimes the value approach, or excuse me, the active approach, is used in concert with that to help get you to that point. But it has to be rooted in value first. If the value isn't there and you can't make a reasonable case for how you're going to achieve that value, then I don't want to even get involved. I don't want to have to rely on being able to remove management and replace them with better management and have to sell off this division and have to do that. Those should be things that, at least the way we approach it, those are things that should all be additive. In other words, if the company is sold, and that's going to create a significant amount of value, and sometimes we only see the real pop in value. We have all these coiled springs in the portfolio, and sometimes we only see that real pop in value when the acquisition occurs, and that may be. But when we actually pencil it out at the beginning, we have that 4 to 1 risk reward has to be outside of an event. It has to be just from normal fundamental operations of the business. And any type of deal has to be on top of that and additive to it. So yes, everything has to be rooted in value first.
Could you give us an example, perhaps a recent investment or a past case study to help us appreciate the opportunities that you were able to find?
There are a few different types of examples that we tend to be drawn to. As I mentioned, it's a handful of industries we tend to do, which tends to be business services. Again, that could be tech services, a lot of different services companies. Some basic tech, if it meets certain criteria, which I'm happy to go into. Some specialty pharma and some basic industrial. But within there are different types of examples that we'll do. So we might do, classic example is one where there have been recent private market transactions that suggest that a multi-division business is worth considerably more on some of the parts basis than what the market is describing. So an example of that is a company called Sapient, which is a Boston-based company. They are the largest interactive advertising agency in the world through Sapient Nitro. They have a consulting business. People still tend to think of them as a consulting business, which they once were. But over 70% of the business is this interactive advertising agency, and there were a number of transactions by some of the large advertising holding companies over the last 12 months that would, if you put even the low-end multiple of the deals that were done over the last 12 months in this space, it would suggest that on a stock that's at 11 and change, that the advertising business alone is worth about $18 a share. You're getting the cash, well over $1 a share in cash. You're getting the consulting business and their government services businesses for free. And if you put the industry low-end multiple on, just assume that their consulting business, which is a very good high-end consulting business, was just sort of an average consulting business, and you took an industry low multiple for that. Same with the government services. You get a value today of something in the low 20s and stocks at 11 and change. And it's one where, if you screen for it and you look at the earnings, you don't notice some of the investments they're making to grow the business, etc. But if you look at it in terms of what are these businesses worth, what would a knowledgeable buyer pay for these separate businesses, the value is about double where the current stock price is if you were to separate them. Another one that's I referenced earlier, the faster growing, higher margin business, and the declining or slower growing ones is an investment we have in a company called RentTrack. RentTrack provides media measurement services to Hollywood studios, TV networks, TV stations, etc. Somewhat in competition with Nielsen, though they have a census-based approach as opposed to Nielsen's broader sample-based approach, so it's actually much more scientific and accurate. But again, similarly, so they have an advanced measurement business that's growing very quickly. The TV business is doubling every year. Very good, high-margin, defensible businesses in basically 100% market share in measuring studio box office, etc. So that they measured 9.5 billion video-on-demand transactions last year. They're in catbird seat. Should advertising be placed in there? That business is growing very well. Has strong secular tailwinds behind it for the next several years. But the legacy business is tracking rentals of home videos. It may not surprise you, not a lot of people going out to rent videos at video stores anymore. And there are some offsets to that, and they've been able to take some share. But while that's a cash flow generative business, it's certainly not growing. And so for a long time, those businesses, the business were not getting proper value for it because people couldn't see the advanced measurement business inside of this larger business. Now the advanced measurement business has actually become more than half the business. So now you're going to see this rocket pull forward of margins and free cash flow generation over the next couple of years. Now that it's more than half the business and the other business is actually declining, this higher margin business is going to effectively become the business. And it's going to be a lot more valuable to some strategic buyer over the next 2 to 3 years. But it's one where it can be completely lost in the crowd because people focus on the legacy business and they think, well, this is what they do and that's going away. And they don't realize that sometimes these legacy businesses can actually generate a significant amount of cash, and it's worth keeping them going because they're cash flow generative while you're continuing to grow out these other areas. We'll look at an earnings blow up where the market overreacts to something. So a company called Spirit Aerosystems. Spirit Aerosystems was originally the commercial aerostructure business of Boeing. It was taken private and then taken back public. And as part of the sale to a private equity firm about 8 or 9 years ago, Spirit was then able to win business outside of just Boeing, so they could manufacture aerostructures and airframes, etc., fuselages, etc., on behalf of not just Boeing, but also Airbus, Embraer, etc. A couple of quarters ago, management took some big charges for some businesses out of one facility that were not doing particularly well, some of them related to business jets, etc., and the valuation got down to a point where you were able to buy, so they make all the aerostructures for the 737 and a handful of other Boeings, including the 787, which has had its own issues of late. But the valuation got down to a point last fall where you were buying the business effectively at a discounted multiple for just the booked 737 business. 737 is the most popular aircraft in the world. They are the only company making the aerostructure for it, and it is almost impossible to displace them. It would take another provider many years of getting up to spec, and Boeing would never take that risk to find another supplier. So they have booked business for many, many years on the 737. You were able to buy this business last fall for just a discounted multiple on the booked 737 business. And there was all this noise in the market focusing on all these other things going on that were very small pieces of the business and what was going on with their Gulfstream business, etc. But 85% of the business was firing on all cylinders and had, pardon the pun, huge runway for many years to come. So those types of opportunities where the market reacts to the latest news and takes a problem that affects less than 2% of the business and applies it to 100% of the business can be a great opportunity. So it was actually a very, very modest position before it happened because it had run up, but we got the opportunity to make it a much bigger position when that had happened, and it's rebounded nicely since then, but still many years of value creation to come from that opportunity. So another example of a good private market comparable and one where you have a business that's well placed and hard to replicate is a business called Haynes International. Haynes is a manufacturer of heat-resistant and corrosion-resistant alloys that are used in three main areas: commercial aerospace, land-based, gas turbine, and chemical processing. Those are areas with many years of growth behind them. Is it cyclical in some ways? Is it secular in some ways? Right? The commercial aerospace market, which historically has had more of a cyclical nature to it, is in the midst right now of what's either a super cycle or a secular change in terms of the types of materials that are being used in engines, etc. They have patent-protected alloys that are used to, again, heat-resistant, corrosion-resistant. So these are materials that get spec'd in to certain jet engines, etc., to turbines that are used for the creation of energy. This business represents, in any given quarter, mid-80% range of their business. So sometimes the business can be lumpy in any given quarter because the one-off special projects may be a little bit more economically sensitive and may not hit. But again, this is years of booked business that they have ahead of them. It's actually in backlog or on its way to becoming backlog. The company has about a $600 million market cap. There's no debt. They pay a dividend. Exceptional management team in Kokomo, Indiana. And last summer, when a lot of the other metals companies and steel companies around the world were trying to shutter capacity and were having trouble doing so because they might have been in countries where it's hard to shutter capacity, Haynes announced that they were going to be spending an incremental $61 million on CapEx to build out new production capacity to meet increased levels of demand. Next day, the stock went down again. And they weren't going to be taking on any debt to do it. They were going to be using it from cash on hand and cash generated from operations. That's what you want to see, right? You want to see an undervalued business that's taking its cash and plowing it back into higher return businesses. They have a very good history of doing this. They're very well positioned for this over the next couple of years. The stock can trade up and down on any given day, and because this is another one, this is one of the 12 million share ones, where there's not a lot of float. If your average steel company is down 2%, it might be down 5% on those days, and so it tends to trade up and down with steel companies or global economic data. Numbers are soft out of China, the stock's down. Numbers are good out of China, the stock's up. But it's really much less related to that. It's not producing commoditized steel, but the market trades it as though it is, and it's worth much more to a strategic acquirer than it is on the market. I mean, if you look at what Precision Castparts recently paid for TimeMet, and you put that multiple on Haynes, which is now a $50 stock, would be a $100 stock. This company is 101 years old, and they've twice been owned by corporate owners and twice been owned by private equity owners. And given the book of business ahead of it, the strong balance sheet, there's every reason that a private equity company could do an LBO of this company as well and create a lot of value, or for a strategic buyer to buy it. But it sits there, not terribly well covered, not terribly well owned, but is a great undervalued business just sitting there, and they're doing all the right things. Management is doing all the right things to create value, and it's just a matter of A, being patient, and B, being opportunistic. So when the stock does sell off because either a short-term issue of its own, a line went down and they didn't ship product this quarter, or because the market is penalizing steel companies that day, those are good opportunities to add to the position.
Well, thank you. You've given us some great examples that illuminate that approach in practice, and what's really come out is that you mentioned words such as undervalued or great management, so it doesn't necessarily mean that you have to change things to realize a good return and the value that was always there.
Correct.
So it's interesting that, again, that point about it's just one other tool.
Correct. The active side is a tool in the basket. Now, there are situations where this is a growth challenge world, and we tend to be investing in companies that, because of their market share position and because of generally a secular tailwind, they should have above average industry growth. Because of that, they should be everything we invest in, we can point to at least 2 or 3 strategic acquirers for whom it makes sense to acquire these businesses, right? Because they're growing faster than the market, they're growing, they generally have high and expanding margins, they're taking share, etc. Good reasons for strategics who might be seeing GDP kind of growth to want to buy some of our companies. But sometimes there are things we can do to try to help that message get out. But other times it's much simpler than that. I have relationships with a number of different companies from having invested in them over the years. I may know a CEO from a company that I'd invested in 5 years ago who might be a perfect customer for one of our current portfolio companies. Again, it's hard to come by growth these days, even for our companies that are seeing decent growth. So if you can make an introduction at that level and just say, hey, I think you might be interested, you should talk to me. I call former CEO, talk to current CEO. Would you be interested in having a meeting? I don't want to, I don't know what the outcome of those things are, but if those things lead to new business, then you've taken what might otherwise be a 6-month sales cycle and turned it into a 3 to 4 week sales cycle, right? If the CEO of the potential customer says this is a good idea and he passes that word down to management, do a deal with these people. You have a much higher chance of that happening than if a salesperson makes a cold call, gets somebody on the other end, maybe it works, maybe it doesn't. If you can help make those things happen, these things all help at the margin. Finding an incremental investor for somebody. If you say, I know a very good, larger institutional investor for whom this would be a good fit, and you make that introduction, you say, I think you guys should talk. You might find this to be an interesting investor, and they become a new shareholder. That helps a little bit at the margin. Maybe it stabilizes the shareholder base. You find them a new customer, maybe that helps a little bit at the margin. But all these things are additive to value during the period of time you're helping them create larger value.
And it's interesting, really, as you were talking about that, I was thinking about, again, that distinction between investing and trading, a lot of in the short-term focus of the market that you mentioned at the beginning. So whereas other investors may spend a lot of time when they have committed capital to a position is to trade around it or to just watch it, you're actually spending time out there thinking about creative ways to increase value, to
Correct.
Reveal value. So in a way, it goes back to what Warren Buffett talks about. Sometimes the best thing to do is nothing.
Right.
And in a way, that focus away from just the changes in the stock price and on business.
Right.
Intuitively, it may help just with being patient.
Well, and it's those changes in business value that are really going to change the value creating opportunity. That being said, it's not always the case in some of the smaller cap companies that we own, but I'm happy to, certainly I'll trade around a position, again, if the market overreacts to something. I don't think of that so much as trading around as making a good opportunistic decision. something trades off on earnings that you already own, you want to add more to it. I'm often thankful for that opportunity. Most people, if they're thinking about the month, they think, oh God, what's going to happen? What's my month going to look like if this happens? And I'll think, well, I want to own this for 3 years, so I'm happy to have this opportunity. I've now just bought more of a business that I think is going to double in 3 years, and I just got it at a better price. But there are also things you can do with options, right? So last week, for instance, the market had a couple of punk days, Wednesday and Thursday. When the market tends to sell off heavily like that, one thing that I like to do is to look for ways to write puts on some of our positions. So when the market's selling off, people get fearful, right? So they're willing to pay more to buy puts to protect their own position. If I have a particular point of view and I think the downside is very well protected, and I think that it's going to be a great risk reward over the next 2-3 years, I'm happy to sell them that protection as a way. It's additive to the value of the position we already own. If the stock does go down and I get hit on it and somebody sells me the stock, well, if I was happy to own it at 20, I'm certainly going to be thrilled to own it at 16. So I'm either going to get more stock, which is not a very frequent occurrence, frankly, or I'll just pocket the premium. So that's a way. Is it trading around the position? Not necessarily, but it's a way to utilize the conviction that you have in a name to create more value than just sitting there and waiting. Because I do think there are ways to create more value other than just sitting and waiting. But there are times when there's nothing to do. There may not be a liquid options market, but you're never forced to do anything. There are plenty of times when sitting and waiting is the right thing. There were some of our positions last week traded off because of as the market was trading down. But the right thing to do in some of those situations for different reasons was just to wait. And those things have since bounced back this week. But the day-to-day noise is nothing more than that, particularly in small cap names. They tend to have more stair-step functions up, and those things tend to be episodic. They're selling off a division, the company's getting acquired, they're doing a refinancing, whatever it is, and then you have some sort of stair-step up. There are a number of things. If you look back the last 2 years, on or around March 15th seemed to be the peak for small cap, and then everything traded off after that. But a lot of what's going on in the market these days is there are days when there's very little single stock purchasing going on, single cash stock purchasing going on. There's a lot more allocation to ETFs. So somebody that wants more U.S. small cap exposure, big allocator, may just be buying the Russell 2000 ETF. And that tends to move things around here and there, but when you have those types of days, that index itself may move 1.5%. You may have small cap names that are moving 5, 6, 7% because people are, there just may not be a bid for those stocks on a given day. It has nothing to necessarily do with the fundamentals of the business, but you may simply lose the bid on those days. And you either have to decide that you don't want to be there chasing every nickel. What I have found to be helpful is you predetermine where you want to add more. So I'll just use the $20 as a round example. You made your for us an average position, we tend to have our top 10 tend to be 60+% of the portfolio. We'll tend to have a handful of ones that are 7, 8, 9, 10%, some in the 4 or 5% range, and some that we're getting into that might be in the 2 to 3% range. Anything less, the only reason we never have a 1% is if we're on our way in or we're on our way out. But that being said, if the market goes through periods of volatility, and so the way I think about those moves is in advance I'll say, all right, I bought this much at $20. If it gets to this level, we're going to add this much more. So if it goes down X%, we'll add Y more. If it goes down another, we'll add this much more. And if you could just, it sounds very robotic, but I can be emotional talking about things because I love this business, but you want to be very unemotional about those purchase and sale decisions. You want to have it be relatively clear cut. So if you're having a day when things are going crazy and somebody in Spain says something and all of a sudden European indices start crashing and people start selling stuff and everyone starts buying treasuries and the market starts going crazy, you just want to, okay, here it is. This is where we said we were going to do it. Let's buy a little bit more. And because there's, especially if you think you're going to be in something for 2 to 3 years, the value of buying it at 20 and then all of a sudden saying, oh my God, it's at 19.90, I have to buy more of it immediately. You'll run out of capital before, especially if you're doing it in small caps. You'll run out of capital if you buy down every nickel. So you have to be some sort of careful about that and plan in advance. But I do think there are ways to not necessarily trade around, but if something gets ahead of itself, there's there's you're not going to you're not going to go out of business by taking some profits, but it's all about the band you're willing to participate in, I guess. People who have more of a trading mentality tend to operate in a more narrow band, and I think people who have more of a long-term investing mentality tend to operate in wider bands.
So I guess the word perhaps is more opportunistic
Absolutely.
rather than
Absolutely.
trader.
Correct.
Right.
Correct. And to that end, we tend to have, I think of cash as a core position for us. Cash is always going to be one of our core positions because I want it there to be opportunistic. If you're fully invested, everything has to compete for capital, so the new thing has to compete with something that's in the portfolio, and that's fine. If I come across something that's now a 7-to-1 risk reward, and I don't have room in the portfolio, then I'll kick out whatever the lowest thing is. If something is now just a 4-to-1, but I'd rather have the cash to be able to be opportunistic and say, something happened today, the day that Spirit had that issue, I wanted to be able to buy as much Spirit to get us up to the position without having to think through, do we have to sell something in order to get there? I'd rather have the cash to be able to do that and really be able to take advantage of those opportunities without having to worry about how are we going to manage our cash position today.
Just a quick question there. In this current low interest rate environment, curious, cash, what do you mean by cash? So is it just dollars, and what is it invested
It's
in?
dollars. It's the stuff.
Not gold
it's the stuff you're having in a want. No, not.
Or Berkshire Hathaway shares.
No, no. There are lots of different ways that people approach that. Some people may hold instead of holding cash, they may hold an index that is their benchmark. So on that incremental capital, they can be assured that they're performing in line with benchmark. But I don't think of us as having that type of a benchmark. We're absolute return oriented. So I'd rather have it in cash because if you're holding it in something else, you still have to sell that something else unless you're going to use margin. You still have to sell that something else in order to buy something. Cash, I don't have to sell. Cash is cash, and that's in the way we construct our portfolio. We tend to have between 15 and 20 positions on the long side. We have a handful of hedges. We have shorts, but we're not looking for alpha generating or stock specific shorts. They're generally industry hedges against some significant concentration we have in the portfolio, and we have options positions around them. We'll write calls against our positions, which also does generate some cash. We write calls against some of our things that we think might be sitting there for a while as a way to generate, or something has really run up. We don't necessarily want to sell it. We think there's a lot more value creation over the next couple of years, but it's had a particular move. I may look to just write some calls against 20% of the position. We'll also, as I mentioned, write puts. So we tend to have something on the order of 70+% net long. We tend to run something in that ballpark.
Now, I want to move the discussion a little bit back to the examples, but also some of the concepts and perhaps even pitfalls when it comes to investing with a private sort of equity type mindset in public markets. And I think there's some distinct ways to, I guess, succumb to some perhaps easy ways of thinking about creating value, and especially in the current, let's say, record low interest rate environment. And you mentioned on a few occasions this, comparing it to private market transactions.
Yes.
And I think from what we've had in terms of experience in 07 and then 08, 09, the private equity type approach to investing in public markets, what is the danger there in a low interest rate environment? Because you often reference transactions by private buyers that supposedly are rational and know what the value is of a business,
Right.
but it's influenced by the leverage and the financing that's available.
Right.
So that's, I think, what got a lot of people with these sort of approaches into trouble in 06, 07, because they saw the private market transactions, but they never recognized the external environment and the low
Right.
cost financing that was available that was driving that more than any value considerations.
Right. Well, I go back to two things. First is, again, when we think about the risk reward, any sort of deal has to be on top of that. So The example I gave you of Sapient, if they never split that up and they never realized that value, it's still an excellent risk reward because of the fundamentals of the business itself. And it doesn't mean that you're going to get it today, though. It may take time for the market to recognize that value. And so it's not event-driven in that sense. I don't need the event in order for business value to be created, but you may need the event to recognize it sometimes because it may be an undervalued company, if you will. So what that means is I'm looking for at least two ways to win. Either the market's going to recognize the value or a potential buyer will. And if we own a piece of a business that is increasing its market share, has high and expanding margins. So tech is a good example. A lot of value investors would stay away from tech products, but last summer it started in May. Last May, early May, I think it was Cisco, obviously an industry bellwether, announced that they were cutting their growth forecasts. Maybe it was originally 9 to 14% or whatever. They were cutting it to 5 to 7%. Over the next 6 weeks, every small cap networking equipment company got chopped 25, 30, 40%. These might have been businesses that were growing at 15, 20, 25% with dominant market share, great tailwinds, etc. And the market just indiscriminately sells these things off. So how do you decide, when you look at this pile of things that got sold off, what makes sense? So we created a list of things that we would look for to tell us that these were good, well-protected opportunities. So they were number one market share, being at least 40, 50+% market share, and expanding that market share. Debt-free balance sheets with a lot of cash generally a quarter to 40% of the market cap. Founders that owned, or either the current CEOs or are still involved and own a significant portion of the company. Now that's something that might scare off other activists, but from our standpoint, that works well. High and expanding margins. So a lot of times in tech, when there's a lot of competition and people are concerned about what's going on in the competitive environment, you may see gross margins starting to come in. If you see a market share leader that's continuing to expand its margins, especially in what's otherwise, every single quarter, these tech companies were complaining about European exposure, right? Europe is hurting them, Europe is hurting them. If they're continuing to go through those areas where even though there's good long-term secular growth, there are pockets of weakness and they're still expanding their margins, it suggests that they're not giving away the product to gain market share. So if you had all of those things together and you could point to reasons why a larger industry player like a Cisco might want to buy somebody to whom they're losing share in the wireless networking space, for instance. You put all those things together, you can come up with a pretty compelling risk reward for what the next 2 to 3 years is going to look like versus what the market is expecting. And if you have, then the sixth factor was all of these companies, after they had been, the ones we invested in, after they had been sold off so significantly, announced either new share repurchase programs or significantly increased the size of existing share repurchase programs as a way to say to the market, our business is much better than what the market is saying, and we're prepared to buy back our stock at cheap prices if the market is going to give us that opportunity to do so. So when you have all those 6 factors operating in your favor, those are ways that you can find very good value opportunities even within a tech equipment company as opposed to a services company where historically I've had much more comfort in services companies within tech because they tend to have longer-term contracts, recurring revenue, better visibility, but that's not to say that you can't find good opportunities on the product equipment side if you can find all of those characteristics.
Now, another perhaps pitfall of investing with let's say, private equity mindset in public markets is we often see investors, perhaps on paper or in their investment cases, put things there that are possible, that can be done.
Right.
And then this question of what is actually the reality of the business, and also in that context, management often comes into play.
Yes, I was just going to say management is the key to that.
So I was going to ask you, I guess, and earlier we talked about that distinction of just looking for value versus looking for a fight that you
Right.
can pick and sort of how to get involved. So help us just understand a little bit more how you make sure you differentiate the two when you go through your investment case on paper to
Right.
not succumb to sort of perhaps some scenarios where you get excited about buying a stock because you can change something,
Right.
but changing that proves much more difficult in practice.
Absolutely. Well, that's part of the reason why you have to speak to management. There are plenty of investors who say, I don't want to talk to management. I just want to see the numbers on the paper and I'll make my own decision. I'll just read the conference call transcript. If that makes sense, fine. But if you're in a situation where you have an undervalued business that you think can really create more value by doing a handful of things, then you have to talk to management to know whether or not that's something that A, they're receptive to, B, is there something in their background that suggests that they are more likely to do it or more likely to not do it for some reason? Are there other things going on in the industry that you can point to and say, well, Company A and Company B have switched to contract manufacturing and their gross margins are 10% higher than yours are. These are things that are going on in the industry. Why wouldn't you do that? And to have those conversations with management. You're generating a lot of cash. You have a lot of cash. How are you going to allocate that capital? You want to see how they think through those decisions. You don't want them to just be rote answers. You want to have a dialogue, much like we're having, and frankly, part of the reason I can do that sometimes is I went to see one of our portfolio companies the other day, and I had last been there in December, and today's April. Right? So the CFO told me that I was the first person to show up since I was the last person to show up in December. So sometimes there's simply nobody else showing up, right? I don't have to tell Spirit AeroSystems what to do, right? First of all, they don't need me. They've built a very good business on their own, and I'm happy to, again, pardon the pun, I'm happy to go along for the ride. But for this other company, which I went to visit the other day, there's stuff we can do to be helpful. If I'm the only person who's been there since December, this company was covered by one sell-side analyst. I said to the CFO has been quiet the last couple of months since the other sell-side firm dropped your coverage. He said they did. So he wasn't even aware. And it's no slight on him. It's just that the firm that didn't think to call him and tell them that the analysts had left and they weren't covering him anymore. And so now we've got a situation where there's not one sell-side firm on Wall Street that's covering this company, a company that has #1 market share in an area with years of business ahead of them, and all they have to do is just be there and catch the money that's coming down in a big bucket, and nobody's paying attention. So there are situations where we can be helpful, and it's also it's a difference in how you approach them, right? If I come into a meeting and I just start banging on the table and saying your stock should be 20% higher because my analyst model says so, well, that's an approach that people might take. But if you can come in and say, we already own some stock. Here's where we see the value. Here's what we think you can be doing over the next couple of years to really create value. And then you get some feedback. If they tell me to take the next bus out of town, I don't really want to own it. And I know there are other people who love that opportunity and say, this is great, we're going to get involved, we're going to get industry people, we're going to throw them out. And that's wonderful, and many of them have had excellent careers and great returns, and that's just a different model. I'd rather find situations where, this one I just referenced, the business itself is going to do very, very well over the next couple of years. There are things they can do to help augment that, augment their ability to create value from that. And there are things I can do to help them get there. And the fact that they're receptive to somebody coming around and having these alternatives, the fact that management owns a lot of stock, the fact that they have significant market share in their space with very minimal competition. They have a very strong balance sheet. The margin profile of the business is going to change dramatically over the next couple of years. Nobody's paying attention to that because it's a small cap company with no coverage. That's an opportunity for us. Most people will say, well, whatever most people do. In general, people don't want to look at those types of opportunities. They think how do I get involved in this? How is this interesting? So that's one where it really helps to have that kind of private equity mentality, if you will, or to think of it as a private investment, because if it has no coverage, how is the incremental data point going to get out there? Yes, the company puts out press releases, sure, but you have to have people who are interested in reading those press releases in order for that to make a difference. So if that company can find a couple of more like-minded investors who want to participate in the upside of this business and want to back a management team that's going to be doing all these things the right way, then it's worth my time to go out there, meet with them, and help them develop a plan for what they can really do to increase the likelihood that that value is realized. And that's really what it is. This is a probability-based lifestyle, if you're endeavor. You want to increase the probability that the value creation is going to occur. I'm not designing these products, I'm not engineering them, I'm not selling them. The company has to be able to do all of those things. And you want to talk to them and sit down with them and really understand how they're thinking through those things. If it's a capital allocation decision, what policies do they have in place to make the go, no-go decision on R&D spending, right? Because you don't want a company that has 3,000 engineers running around and everyone's got a new idea for how to make the next great thing, and they have no controls in place for how to make those go, no-go decisions. So you want to have those conversations with the CEO, with the CFO. You want to walk around. If I'm the only person showing up, the company doesn't have to put out a filing to say, we met with somebody today and we talked about the future of our business. If nobody else is showing up, I can't do anything about that yet, other than maybe finding some new people to meet with. But if I can walk around and see what's going on and get a feel for how the business is developing, if they have a few facilities, if I can go visit the facilities. I mean, this is what you're supposed to be doing, right? That's research. You're supposed to understand the companies that you're investing in. You're supposed to know what they do and how they do it and how do they make their money and how much of the growth is price versus units, and do they have pricing power, and did you talk to customers and what are the customers likely to do, right? So you talk about how investors put in write-ups about what might happen. I would say companies put out things all the time. Well, we're going to do this, and we're going to do that, and we're going to do this. So you have to benchmark that against reality, right? If they say they're going to have 60% gross margins, and they've never been above 40% once in their career, and you look at the industry, and you look at the players that are in their industry, upstream, downstream, and nobody's been above 42%. How are they going to get to 60%? What is the rationale behind that? And maybe something does make sense, but you want to understand what that process is, and you want to talk to suppliers, customers, etc., to understand how do they really go to market. Is this product really valuable? Because you go to a company's website, everybody's a leading provider of everything these days. Nobody ever says we're the substandard provider of this, or we're a tertiary player in this space, right? Everybody is a leading provider of something, right? That's got some sort of lawyered up language that makes them the leading provider of something. We're the only Ronkonkoma, New York-based provider, leading provider of this. Well, if you define it small enough, you can be the leading anything, right? I'm the leading Edenbrook capital in the world, right? So you really want to test these things out by going out into the market and not just taking what they're saying at face value. But you have to balance it. You ask for a pitfall, and I know you keep asking this question. I keep avoiding it. But one pitfall of any type of investing where you're not running the company is you can't fall in love with management, right? You can't just take their word for everything. It's not quite as harsh as trust but verify, but it's similar. And you want to be close enough to be able to have your finger on the pulse of what's going on with the business, so you can see. For every investment, you should be able to identify the 3 or 4 levers that are really going to create the value over the next couple of years. And when the noise is coming at you, and sometimes you're standing there and you can see the value. It's like a fixed light that's very far away, because it might be 3 years from now. And you just keep looking, and if you can still see that light, you're heading in the right direction. But all of a sudden, the market and all these things start coming at you, which just create wind blowing in your eyes and junk and refuse and everything's flying all over. You keep looking to see if you still see those lights out there, right? And if you can still see those lights, that means that the investment case is still intact. But you have to know when it is and when it isn't. You have to know when management is telling you things that are either off track or different, and some of it's just showing up all the time, right? If we keep having these conversations over time, you're going to know whether or not I'm telling you, I may be giving you the same answer, but am I giving it to you with the same level of conviction? Am I slouching a little bit more when I say it? It's not as far as poker and reading tells, but you can tell if somebody was really optimistic about their ability to enter a new market and take share because of this, and then a year later, we think we can probably get there, and there might be an opportunity out there. And all of a sudden, does that change my investment thesis? How much of my investment thesis was predicated upon their taking share in this market? And you have to go back and revisit that investment thesis. But you want to develop a good enough relationship with them that when something does happen, they're going to call you, right? So if when something happens with one of our companies, particularly one we're comfortable with, I'd like to, just like anybody else would want. I want to talk to I like to talk to them. If you don't have a relationship, it's very hard. It's very hard when you have a problem to then call them for the first time. If you hadn't been there involved with them, though they may get back to you, but they may not. And again, they're not telling me anything that they're not telling anybody else. But it's just a question of whether or not if you've got some history with them, you may get that call sooner, or you may get again not sooner in the sense that you're getting more information than anybody else, but just you're able to determine what if something that's causing a stock to move is really noise versus news. And anyway.
Well, when we are talking about these sort of pitfalls, and I guess to take you said you don't want to fall in love with the sort of the figures, with the management, what they're telling you, and with a lot of people who like to get more involved with companies and the so-called activists, if you will, as a sort of most extreme example of private equity type investing in public markets. One of the pitfalls really is, I think, getting a bit obsessed about this control.
Yes.
And how sort of where people become overconfident about their abilities to influence
yes.
events, which speaks really against this value investing notion of well, we don't know everything and nothing
right.
is precise.
Right.
And if you could give us a sense how you deal with that and make sure you don't necessarily, even though you have the toolkit in your arsenal to get involved
right.
and influence things, to actually
sure.
Not get obsessed about that.
Right. Well, and I think, just to go back 1 second, the concept, I'm very happy to find a management team that I have a high degree of confidence in and that I respect a great deal. What I mean by not falling in love with them is you don't want to take everything they say as the gospel. And when something goes wrong, you have to have the kind of relationship where you can talk to them about that and not say everything's fine, believe everything they're saying. Sometimes things start out one way and they go in a different direction, and you have to be able to say, you know what, something has changed here, and it's not the risk reward I thought it was, and management's saying something different now than they said a year and a half ago. And every investment case is built on certain blocks, and if you pull one of those blocks out, the investment case may fall apart. And you have to be intellectually honest enough to say, that's not why I invested in this company. They're changing gears, they're doing something different, and if that's the case, you have to be willing to say, the time you've put into it is sunk. If maybe you're down on the investment, whatever the case might be, if the investment thesis no longer holds true, and you can't reasonably see the ability to still get that 4-to-1 risk reward, you just have to say, that's it. Move on to the next thing. In terms of the control aspect to it, I think there are a couple of current examples in the market right now of some high-profile companies where people thought that they could change things by being in control. And as I said earlier, I'm not the person selling the product. I'm not the person designing it. And I think that's something that you're seeing right now with some of these cases where the customers out in the marketplace are determining that certain companies are not worthy of their hard-earned dollars, and so business is going way down. Sales are going down, and it's very hard to right the ship when those things, if you have high fixed cost base and sales start going down because customers don't want your product anymore, they don't have the same perception of value for your product that they used to, and all of a sudden you think you can start changing the value of the company overnight by browbeating people. It won't work, right? A company's revenue is only comprised of two things: price and units. And if those things are going in the wrong direction, it's very hard with a large fixed cost base to have the fundamentals of those business work in your favor in the near term. And you can tell management whatever you want, unless management's putting out a product that people want to buy at a price they want to buy it, you're not going to drive the business. And so I think that you have to be very careful about assuming you're going to be able to take any sort of control. And of course, we're not trying to do that. We're trying to be constructive and collaborative. But again, it all comes down to whether or not it's rooted in value. And I think if you look back at some of the current examples that are out there in the marketplace, you really have to ask what assumptions were they making when they invested at twice the current price. The stock has gone down a lot because of eroding fundamentals. What assumptions were they making then about how the fundamentals of the business were going to play out over the next couple of years in order to warrant the price that they then paid? I scratch my head coming up with answers to that.
And I know our audience is certainly curious to hear what sort of examples you had in mind there as you were talking about it. If you care to share, or I'll just throw out, I guess, what I was thinking was perhaps J.C. Penney.
That sounds familiar. No, I'd rather not comment on anything specifically, but that is an example of one where the business model is changing quite significantly, and now maybe they're deciding it isn't going to change quite significantly. Right? They're bringing back the old CEO. Is he going to run the same playbook? What commitments did they make to either retailers, or what commitments did store operators make to the operators of these stores within the stores that they want to do? What capital can they actually call back versus what's been committed? I don't know the specifics of that. That's a much larger situation than we generally look at. And the firm that's well involved has an excellent track record in a number of different situations, and I imagine they have a plan. But that's when you look at it from the outside. You think I'm not sure what process. I'm sure they had a sense of value when they invested in that, but I don't know what assumptions they were making about. Again, taking that one aside, in general, I'd say sometimes in these control types of situations, or when someone's really trying to exert control, they may look at things in a vacuum and say, I'm going to assume the business is going to stay as it is, and our ability to change things is going to be on top of what this existing base is. So this, where it is now is the base. And sometimes that base can prove to be much lower than you really think it is because things are changing and the market may or may not be receptive. I don't know if that's what's happened here. I have no idea.
And let's, of course, your focus is also on the smaller cap space,
right,
where some of these drivers are very different. I guess I was just curious, lastly, to understand in terms of this control that you mentioned, and that's perhaps a good example where, again, you're saying go back to what you were thinking back then, and there certainly is always a plan B, sort of a downside protection case, and
right,
with activists. And what we've seen perhaps in the past is where, and you alluded to this in your portfolio, you have to really be concentrated. You can't have small positions, and then if you need to resort to plan B in a lot of these cases,
right,
at the same time,
right,
you get into trouble,
yes,
and also perhaps because of the structure of your fund, etc., etc. So
yeah, I mean, I find that being concentrated allows me to know the companies in my portfolio extremely well. If I've done the work correctly, it doesn't mean that if we have a concentrated position, we might not sell it before value is realized, because again, things can change. Management may decide something. A regulatory change may come, especially with this environment, out of Washington, out of nowhere, and all of a sudden, your risk reward may change. But in general, by having a relatively concentrated portfolio, I feel I can know all of the positions extremely well. I can know the companies, and I can know for each company, wherever I am, walking down the street, if somebody stops me and says, what is your investment case on this thing? I know exactly what it is on 3 or 4 points. I know exactly what the points of value creation are. And if something happens and news hits in the industry from a competitor, something going on upstream or downstream or with the company itself, I can immediately say to myself, try to think through, how does that impact any of the things that I thought were the levers of value? And often, the news is just noise, and the answer is it doesn't impact it. But the market may think otherwise, or really, in the short term, your performance can often be attributed to somebody else's decision to buy or sell something that you already own, right? So we're in these things sometimes with a lot of different types of people. You like to think everybody is patient value investor who finds the opportunity, and they're going to go in and you'll all build value together. But you got people zipping in and out of things all the time, and we have things that we own that we bought when they were completely beaten up, and the stock charts looked like very nice ski slopes. And then all of a sudden the thing started to work, and then all of a sudden some fast money comes in, and the stock runs up for a little while, and then all of a sudden they're gone again. And so sometimes you're in these things with other people, and so the movements can, especially in small cap names and even some mid cap names, can be much more pronounced than they are in larger cap names. But by knowing them well, you can really, it's much easier to make those decisions and say I'm buying, I'm adding, I'm selling, I'm trimming, whatever it is, whatever the right decision is. It's easy to do that on a relatively concentrated portfolio. If you have 150 names and you have a blow up, A, it doesn't matter. But if you have and B, if it goes in the other direction, it doesn't really matter. Nothing's big enough to really influence the portfolio. And those are more like, that strategy works for certain people, but that feels more like a quasi-index fund. If you have so many names, you're just approximating the market at some point.
Well, Jonathan, we've touched on a lot of subjects here, and I know you also teach a course on value investing. I was curious if there was anything we haven't discussed where you feel perhaps is really important, a topic,
Sure.
or give us some insights into your teaching
Sure.
course.
So I teach a class, Advanced Topics in Value Investing, at the new Gabelli School of Business at Fordham, and that's a wonderful program. And I'll say two things about that. First, based on what I've seen from the students this is the first year this course has been taught, we have a very bright future in value investing. I'm very impressed with the caliber of the students and what they're able to accomplish. And there is, at the younger levels, a real curiosity for real applied value investing. People coming out of this program, based on the type of work that they're doing and the questions they're asking, there's definitely an interest in going back to more classical types of value investing and finding good businesses and understanding what a business does. And I think that's so important for anybody that's thinking about investing, whether they're dabbling personally or certainly if they're doing it professionally, is to really try to understand what the business is doing, how do they make money, and why are you investing in the company? What is your rationale for investing in the company? So just this last week, we've divided it into 2 weeks. Students are making presentations on different companies. They have to pick a company and produce an investment case on it. And one of the things we've been working on for a lot of the semester is really trying to understand the business and the drivers of value. And if you can do that, you've gone so much of the way towards really understanding whether the probability is in your favor or not. It's an expected value game, right? And this is all about expected value. You have, nothing's ever going to work out exactly. You see these pinpoint numbers for what a business is worth. South Street sell-side numbers come out, and this business is worth $46 a share. Now, most of the time, a business is worth some sort of a range, right? Because it's based on a handful of variables that can all play out each of them on a spectrum of probability. So that relates to that leads to different expected values. So the ability to really understand the business and what's going on and how that's likely to play out over the next couple of years, and what's likely to influence your investment case, are really important building blocks for understanding value and creating value. And it's been very instructive to me to now be teaching this, to see from their standpoint how, by focusing on the business value, they really get what the impact of that is on value creation. And it's Mario Gabelli helped create this program, and obviously one of the core Gabelli tenets is private market value. So that's definitely been an aspect of what we've been doing. But I think that's a very helpful way to look at things. There are always these disconnects between private and you see it now. You see private company valuations. So you have a business like Square that has higher valuations than companies with 10 plus times the revenue that are in the transaction processing business. These things often don't make any sense. And you have these huge arbitrage opportunities between public and private multiples sometimes. And I think by taking a step back and saying, well, what does this business do, and what do you have to assume to get there, right? If you look at, Facebook is obviously a much bigger company for now than anything that we traditionally look at. But if you look at the price today and you say, you know what, in order for that to make sense, I need to have a 10% return on that company over the next 10 years. And then if you back into what that implies for growth and what the margins have to look like, you have to make very heroic assumptions to get there. Similarly, even an example, we had one of my students very fond of Google Glass, which looks like something out of James Bond. It might be fantastic, but he was convinced that Google Glass was worth $200 a share to Google. So we went through the exercise of disaggregating that in terms of what that meant. What is Google Glass $1,500 a pair? What the estimated margin on that is? How many pairs they'd have to sell? Want to hazard a guess as to how many pairs of Google Glass they'd have to sell in order to get $200 of value on Google stock? 350 million. 350 million pairs of Google Glass. That's a big number. And honestly, the market's assuming that, but this is one person's assumption. But I think it is important. The bigger point of all that is, I think it's important to take that sort of practical step back and say, not get so lost in the numbers and what does this 50 basis point change mean in R&D margin 2 years out, but to take a step back and say, does this even make sense? What is being assumed by the market, and why is my point of view different than that?
Well, on that note, Jonathan, I really want to thank you for all your
very
time
much.
and the insights.